Make sure you hit the subscribe button, as that greatly helps us keep putting out daily content to keep you updated on the market.
From 2018 up until the beginning, or not really the beginning of this year, but probably Q4 of last year, you could have calculated an incredibly tight correlation between the stock market and the Fed money printer. So the Fed is in control of how they can introduce dollars into the economy. How do they do that? They literally manifest money. They don't actually technically print it, but let's just assume for these purposes that they actually do print it. And they literally take that money and they enter the market and they buy things with it, and they're giving you this newly created money that they just created out of thin air. From 2018 up until about Q4 of last year, there was a 0.92 correlation between that and the S&P 500 going up. What does that mean? So if you look at a -1 correlation, that means that if something goes up, this thing goes down, dollar for dollar, that would be perfectly negatively correlated. If you look at something that has a 0 correlation, that means it's just random. Whether one thing goes up and down has no influence on the other. But a 0.92% correlation effectively means that for every dollar the Fed created, the stock market was going up by that same dollar. And that is literally what we had up until November of 2021. Since the beginning of this year till about yesterday, so I think the number is still going up, probably by at least by $1 trillion, we have destroyed collectively as a society $35 trillion in global market value. Now, to give you a sense of that, that's 14% of all global wealth that has been destroyed in basically 5 months. And for reference, in 2008, when we went through, a cataclysmic shock to the system that threatened the banking infrastructure of America and a potential contagion to the world, that destroyed 19% of the world's global wealth at that point. So, we're approaching some really crazy, heady moments in time where, in terms of the market correction and the value destruction. The difference here is that the last time around, it was really about a handful of financial institutions and some very specific assets, right? Mortgage-backed securities, some parts of the credit market, and then a bunch of financial stocks. And that was largely it. This time around, it's literally everything that's getting smoked. There is not a place that you can effectively hide that has been safe. Crypto, smoked. The credit markets, totally frozen. The equity markets, NASDAQ is in a bear market. The S&P is basically flirting with the bear market now. And I don't really see any end in sight. Meanwhile, we're waiting for CPI to downtick. Inflation hasn't really done that. Separately, jobless claims are now starting to tick up, which means that companies are beginning to effect layoffs because they feel this pressure. So now you're going to see an unemployment rate that starts to go up. And then meanwhile, we're fighting a proxy war in the Ukraine against Russia to the tune of about, $40 billion every sort of month or so when we open the paper and decide to read about it. So you put all these things together, it's not clear that there is the momentum to create a market bottom. Just to be clear, we actually haven't started to remove the money in the system. So the process of quantitative tightening, which is the Fed's mechanism of removing liquidity, is going to start now to the tune of about $90 billion a month. But to run off all the money that they printed will still take 3 years, right? So we have to take about $3 trillion of excess capital out of the economy. And so if you add that 3 trillion as well, that's just going to disappear to the 14 trillion we've already, or the 14%, the 35 trillion, sorry. You're starting to touch numbers that are, as bad as the GFC in terms of global wealth destruction. Unlike the GFC, this wealth destruction is touching a lot of normal, everyday folks in very broad-based ways. And that wasn't necessarily the case. There were a lot of people that unfortunately lost their home, but even that was still relatively contained to the hundreds of thousands. Here we're talking about tens of millions of people owning every kind of imaginable asset class who's seen wealth destruction, somewhere between 25 to 90%. Now, you can say, what is the canary in the coal mine? And let me just give you one thing that hit the wire this morning, which will show you how bad the credit market is. So there was an article in Bloomberg that came out that said, instead of Elon taking margin loans to fund his acquisition of Twitter, there is an idea being floated by Morgan Stanley to use convertible debt. Now, I love this idea because I think it's an excellent mechanism. This was when Elon had convertible debt on Tesla, that was, one big escape velocity moment for me in my career in 2016. So I believe in these products. I believe that they work. But the reason I'm bringing this up is that what it said is, I'll just read this to you. The preferred equity may have a 20-year maturity and include a feature allowing interest to be paid in kind at a rate of 14% a year. If the single greatest investor's cost of capital for debt in today's market is 14%, I think you have to really start to question what the credit markets really look like for market clearing prices. Because if that's the price for a risk-bearing asset run by the greatest entrepreneur of our generation, there's a bunch of stuff that's pretty mispriced.